everybody. Thank you for so many of you who made it back. I think we'll probably fill up throughout the morning. It's my great privilege to introduce the second session. And it's always wonderful going to these events and being able to meet such stellar people within the industry. You don't need to laugh, Nigel. But I think, given what the subject of the panel, which is what can we expect, I think this, obviously, I'm really looking forward to finding out what the industry holds for us in the next year. But if anyone can tell us, our panel can. So we're going to have this a similar format to the first session, where I'm going to invite the speakers to introduce themselves. What's going to be different from this session is we're going to have a number of presentations, but there'll be plenty of time, hopefully, at the end for questions and answers as well. So I believe our first presentation is from Peter Sands. So Peter, maybe you could find your way to the lectern if you want to.
Yeah, I would love to, but all right, that's much better.
There we go.
I was just about to give it over to you, Miguel, to give a few pointers in terms of where the markets will be heading as anyone with a stake prepares for the next normal. Because a new normal, that's just a crappy phrase, isn't it, right? We always prepare for something new, while looking for similarities to comfort us that things will get back to where they once were. But they never will, at least not on a 100% basis. So what we constantly try to do at Soneta is to enrich the crowdsourced data that we get from our customers, short-term, long-term contracts on container shipping freight rates on 170,000 port pairs, to be able to actually have an educated view on what comes next. Shippers in and out of North America are probably screaming for help right now. Very early on in the tariff war, I said they were paralyzed. Somebody said, hey, they can't be. Only a few weeks later, I think we got confirmation that when you're operating with so much uncertainty and risk, what can you possibly do to prepare your supply chains for what comes about in the next hour, in the next day, or in the next few months? Fortunately, we got a little bit of more quiet and calm times on the Transpac right now, but it should not be a resting pillow for anyone as we also prepare for the next normal. So just a brief agenda as I will run through the messy 90 days. I will shed some light from our platform, and I will also give you a few more, overall levers for you to understand what is actually coming around for you to manage very, very soon. Because things seems to change faster than ever before. In order to understand where the market is, it's not good enough anymore just to have a market average. Because are you an average shipper? Are you an average forwarder? What kind of price should I be able to prepare in the market when the forwarder or the carrier says, jump? And you better reply how high, because you haven't got a clue on what should the price actually be. What I'm showing you here is a little bit of a very fast changing market. This is a main trade lane, China, US West Coast, much into the spotlight right now. The dark blue is the orange. Sorry, the dark blue isn't orange, and black isn't the new orange, but the dark blue here is the market average, right? And when you have a mid-low and a mid-high, those are the 25 and the 75 percentiles in the market. So if you're really good at negotiating rates, if you're a big-sized shipper, then you are paying closer to mid-low throughout, and the opposite, of course, if you are not, then you're paying mid-high. So what do you see when the markets all of a sudden jump? Well, those with a lack of insights, or those that haven't got the levers really to pull when negotiating contracts, they get 100% PSS or GRI asked by the carriers instantly. So that jump from $3,000 to $6,000 impacted very much the high end of the market, with anyone else also a little bit later catching up on that. This one is taken on 11 June. If we fast forward to where we are today, you can see some of that uncertainty in the market where there's a big gap between mid-low and mid-high has come down. And that's of course because the market dynamics constantly change. Carriers are bringing capacity back to the Transpac, capacity they pulled out as the tariff barriers were elevated in the immediate aftermath of the so-called Liberation Day, in particular against China, but also against Southeast Asia and anywhere else. So this kind of insight, of course, you need to understand in order to position yourself for the next normal. And in order also to understand if you go tendering, is now a good time to do that? Probably not. Right. So are we off to a good start or what? Well, that really depends on the eyes of the beholder, right? If you are a carrier and forwarder, probably you are enjoying a really good time right now. Demand on a TEU basis up by more than 5% in the first 4 months. That's pretty strong, especially if you see against our expectations for the full year, no more than 2%. That's due to the politics the negative impact from politics, the global economics not really being that good, and because we trust that the high demand growth last year as well as this year is due to front loading. Shippers being scared, shippers really trying to fill their inventories before the next problem hits their supply chain. So, this update is from it's for 2 weeks ago now. Our mid-year 2025 outlook was released. I'll share a QR code with you later for you to scan also here in the audience, so you can pick it up on yourself, so you get the full range of insights. This one is also one favorite of mine because there still seem, even though I've only been around for a couple of decades within the maritime analytical world, so to speak, and it always puzzles me a little bit when people believe that, hey, look at the chart like this, look at 2025, 2026, the fleet growth is coming down. That means that we're moving into a much stronger market from a carrier's perspective because supply isn't growing that fast, but demand is picking up. To me, they're ignorant, or they're just trying to pull your leg. Because obviously, when you have a fleet that is growing throughout, the most important thing is how many ships are actually around already before new ones getting injected, right? So understand the overhang of capacity that's built up with the money made during COVID, delivered during 2023 and 2024. But the one thing that you can take away from 2025 and 2026, let's look at what's left and what's already been delivered into the hands of the carriers for the first 5 months of this year, and also what's left for the rest of the year. This kind of insights is, of course, playing right into your hand as a shipper or forwarder if you want to play that game of, say, delivery with the carriers. Because arguably, a company like MSC has a lot of ships to feed into their network, regardless of the fact that they may run the biggest network of them all, and they're running a lot of, say, port-to-port pairs, arguably, very much continuing of what they have been doing for many, many years. And also, perhaps also the reason for them to split with Maersk then forming Gemini alongside Hapag-Lloyd, doing it very, very differently, hub and spoke. More on that in the report, should you care, and I think you do. That's why you're here, right? But understand which carriers are under the most pressure for feeding more capacity into their networks as the year progresses. Obviously, intel to make use of. Also, just highlighting the fact that once we have the crowdsourced data within our platform, we also enrich that with data coming from other data partners and data providers in order for you also to get better grip on how carriers are deploying capacity on individual trade lanes. And the opposite, literally, taking out capacity when demand isn't there. So on this chart, I have decided to go for Far East to North Europe. We're in North Europe right now. And back in the early days, or the late days of first quarter, early days of second quarter, we basically had carriers blanking a lot of sailings. In particular, the MSC, as you can see here in the gray line, blanking almost 70,000 TEUs on a 4-week rolling average in the early days of March. That is capacity not available to you guys as shippers, but it may just also be because carriers were a little bit too optimistic planning for the weeks around that day. But it may also come about, especially during times like this, it has something to do with also the reshuffling of the carrier alliances. But as we speak here on 16 June, we're definitely also beyond that point. All the new networks should be in place, right? It takes a lot of time, of course, to reset those networks, but it doesn't take more than 4 months. Right. Just to bring home the main point of the market still, as we see through the mist of policy uncertainty, as we see through the mist of, in particular, the Trump administration trying to pick a trade war with any country around the world. With a lot of uncertainty, mostly around imports from Southeast Asia, imports from China. So we're really looking at the window of opportunity for shippers to front load. That will close in 1 month when it comes to Southeast Asia. Around 9 July, that window will close because that's the end of 90 days. We need to go all the way into 14 August to see the window closing for Chinese imports, right? So in between now and then, we will definitely see fluctuation, we will definitely see uncertainty, and we cannot really rely on the information that we get out. So hope for the best, prepare for the worst. Bring a few contingency plans around. I mean, we may have heard something like, okay, probably tariffs on Chinese imports into the US will be around 55%, 20% from fentanyl, 10 on whatever, 25 on what was around after the initial trade war instigated by the first Trump administration. In total, we get to 55%. Still very, very high. To me, it doesn't seem as if we have called truth on that. Our anticipation is that the tensions between US and China have only just begun, right? So prepare for a massive rejig of supply chains if you really believe that resilience is what you need. Don't just do the relatively cheaper option of front loading, because in the end your inventories will run low. In the end you will have a problem finding a new market if you're completely priced out of a new one. So I'm pretty sure that you have already prepared well, but I think you can only get yourself started thinking about new scenarios as time progresses, because nothing is standing still. It's an ever-changing market, but obviously, and this is also one of the things that we hear from our customers when being in conversations, and also something that we suggest them to do: use the intel available for building better scenarios around your future planning. Because plan to the largest extent possible. It will never play out like you planned, but at least you got some backbone to run it on. You can't just run around acting last minute. It doesn't work like that. I'm pretty sure you guys in here are not doing that either, but you're probably also pretty exhausted trying to think of new ways of thinking around it all the time. But use the data, use the intel to understand the significance of why rates are still elevated, why the need to find China plus X, I think some of the bigger forwarders now call the diversified sourcing strategy for their customers. I mean, it's getting more complicated by the day. Arguably also carrier networks gets more complicated. As you can see on the left-hand side here, as I'm just about to conclude my brief here, there's definitely a knock-on effect from the developments in the short-term market onto the long-term market. But you also see that the drama and the most fluctuation is in the short-term market. But there's a limit to how much you can actually only rely on the long-term market. If you haven't heard about it, indexed in contract may be a way for you to secure that your cargo gets moving. It may not be at the price that you hope for in the first place, but you're not priced out of the market, because that's one thing that you probably recall from the past. Getting cargo rolled pretty unfortunate if that is time-sensitive goods. All right, I'll just leave this up for a few seconds because that's a QR code for you to scan in order to get the full insights into our half-year update outlook. And why it's a half-year update, that's because back in October last year, we basically spilled the beans fully, and we then reflected on some of it and bringing everybody up to speed again on the current market conditions. But in brief, get your head around the market all the time, right? But be absolutely aware of the fundamentals, because you get lost in translation, so to speak, of various social media posts from the heads of the world. Tricky, really, to negotiate. On that happy note, thank you so much for your kind attention, and looking forward to taking any questions, comments you may have on stage or right after this one. Thank you so much.
Thank you very much, Peter. I think what we'll do is we'll take some questions from the audience right at the end after everyone's presentation. But before you can relax, Peter, and thank you for being very timely as well, and a good standard for the rest of the panel, I have to say. What I find difficult to understand, maybe you can explain, is when there is so much capacity in the market, why are rates so high? And given this sort of strange situation, how can shippers use your data really to judge what's going to be happening in the next 2 quarters?
I think it's important to understand that no two supply chains are alike. So rates are still much elevated from the pre-Red Sea situation on those trade lanes that are directly impacted by the Red Sea. On the Sonata platform, we also have market rate outlook, which is basically our forecast for the long-term contract rates, where they will be. And our customers can there see that some of that premium still being paid on top of pre-Red Sea levels on the long-term contracts are still elevated into Mediterranean, into North Europe, to a little extent also US East Coast when we come to the third quarter of this year. But on a specific trade lane like the Transpac, there is no more ripple effect from the Red Sea element on the long-term contract rates, let alone the short-term contract rates that are decided by something else these days. So a part of the explanation why rates are so high, risk and uncertainty, super duper powerful tools to disrupt the sentiment in the market, but definitely also the still strong demand that we see up 5% this year in the first 4 months of the year. I'm sure Nigel will give us a few more insights into how it's played out differently. These were the global numbers only, but also on the back of last year. And then the Red Sea is the important factor making the market tighter overall. So if you recall the freight rates of 2023, Q3 and Q4, those were loss-making for carriers. So it's the one factor that makes the whole lot of difference. So, and right now, I think, in particular, the American importers and exporters, they are more worried about the impact of tariffs, getting their goods priced completely out of the market. So they are ready to pay double the freight rates instantly, because that's the least of their worries as it is right now. So you're really between a rock and a hard place from a shipper's perspective, while trying to basically maneuver the crazy waters. Let alone if you've got business in the Arabian Gulf these days or upper Indian Ocean, that's another curveball for you to handle in terms of the goods en route.
Great, thank you very much indeed. Right, let's move on to our next speaker, Miguel Angel Luna, hopefully that's a reasonable approximation, who is Head of Commercial Marketing and Sales, Port Authority of Santa Cruz at Tenerife. So, yes, we got the right presentation. So thank you.
Very good pronunciation. I think I congratulate you for that, John. So, thank you all for being here. Thank you, my fellow speakers, to be here as well. I think we have made a great team to tackle this relevant issue at the moment. A little bit of me, a little bit of background. I'm working as a commercial and business development executive at Ports of Tenerife, the Canary Islands. I have always been linked to international trade. I even started working as a doorbell guy in a hotel, in a four-star hotel in Tenerife many years ago. So all my background has been always linked in some way to meeting new customers and people from all over the world. What I intend to do here today, it's trying to present you the role of my port, the role of Tenerife. How could we help, and how are we helping shippers and operators alike to resist all this changing world that we are all living, and even more after last week's events in the Middle East, right? So I will start very briefly for the index I have prepared. I tried to be brief. And I will start with a bigger picture of where we are located, right? Many of you might already know about Tenerife. We are located around 300 miles from the western coast of Morocco, somehow close to the Spanish mainland of around 1,000 kilometers away. When I speak with other fellow colleagues from other parts in the world, the first thing we do is we all have the best location anywhere. But in the band of Tenerife, I think it's true. There is no doubt we are very well located in a crossroads between Europe, the Americas, and Africa, and we have been playing a very important role since the best start of the Red Sea crisis in 2023, if I'm not wrong. Well, Tenerife is a top spot tourist destination. We received in the whole Canary Islands, not just Tenerife, 18 million tourists a year in 2024, which is a great number. I saw a description. Well, I saw some news some weeks ago that Tenerife received in the first quarter of 2025 more tourists than Brazil, which is quite a number already. With that, I'm trying to give you an introduction of where we are and who are we in this kind of stuff, right? So, and who are we in as a public body? Ports of Tenerife is a public body in charge of managing a total of 6 ports in the western province of the Canary Islands. Being the most important ones, the 2 located in Tenerife, the bigger island you can see in the picture. The one in the very north, Santa Cruz, is located in the capital of the island. And the most recent development, the port of Granadilla in the very south, which is under construction but already operational, as I will show you later. The other ports are mostly used for inter-island traffic, ferry passengers mostly. And to help you understand what's our role, I will show you some facts about the port itself and how we are in the context of the Spanish port state public system. Last year, 2024, we moved 14 million tons of total goods, being ranking the number 13th in Spain. This is not probably quite a number, but when we're speaking about, for example, passengers, we are almost 7 million passengers in total, being the number 2nd in Spain. And this also includes cruise passengers and ferry passengers alike, right? With cruise passengers being around 1.3 million last year. 17,000 vessels yearly last year we received, and as we are in a container supply chain conference, I didn't want to leave without mentioning the number of TEUs we moved last year. more than 500,000 TEUs moved last year, which in comparison with all the Spanish ports, we are number 5th. It's not that big. We have, for example, Algeciras, Valencia, Barcelona, any other place in Spain moving much more than we do. But still, we have been growing quite a lot, as I will show you later. And also, as I mentioned before, the number of cruise calls, we are one of the top tourism destinations in globally, I will say globally, and especially for European people, right? With all that, what I'm trying to say you is that we are a multi-purpose port, receiving any kind of traffic. We have 2 container terminals, and we will show you later. I will show you later, and also with an anchorage area with an occupation with a very high occupation rate for ships of any kind doing operations. We also have a strong naval repair sector with the offshore industry with a very good position for the West African and Brazil coast. Next year we will have the new floating dock available for the local shipyard. And as I am a man of numbers, I would like to show you some facts about the port itself very briefly. So I took these 2 main points, which are the provisioning, including water and bunkering mostly, and the number of TEUs, both measured in thousands. Okay, since 2022, we have seen an increase in numbers in our figures for both traffics, and the forecast for 2025 is to be around 12-13% more than in 2024. Mostly thanks to the transshipment traffic we are getting because of the Red Sea crisis. And yes, this only shows that we are undoubtedly, with no doubt, located in a very on the very good position to attend all these challenges we are all facing. Hope to be back to normal as soon as possible, but there is no doubt that Port of Tenerife is well positioned to attend this unexpected, I would say, demand. And how we are doing this, thanks to our 2 container terminals, private operators competing each other, with 25 hectares of surface available for local traffic, captive traffic, of course, with the population of the island, and of course with the number of tourism we are receiving, as I said at the beginning of my presentation, and also transshipment traffic we are getting now. Very quickly, one of them is Boluda Maritime Terminal with a capacity of nearly 4,000 TEUs per year. We are now getting Grimaldi doing transshipment operations for eastbound, southbound, northbound, mostly for Africa and for South America. TCT, Tenerife. This is a bigger container terminal as the previous one, and with a draft up to 16 meters. Port of Tenerife is a deep water port offering superb infrastructure, and we are getting here Gemini. We are getting transshipment operations from Maersk and Hapag-Lloyd, and also CMA CGM. And so a point I would like to emphasize, as we are very committed to sustainability, I have no doubt about that, but also about making our business grow. So we are still waiting for the right funding, but hopefully in the midterm, OPS will be available in both container terminals, offering up to a 50% discount in the port taxes for vessels calling at Tenerife, which is already quite a number. Granadilla, the second port in Tenerife, which I mentioned earlier as well, not really getting into container traffic, as this container is in the very north, in Santa Cruz. But Granadilla is probably the biggest and latest development in the port development in the Canary Islands. We have been receiving even the biggest vessels. Many of you may probably know Pioneer and Spirit. This big vessel was here in Tenerife doing some reactivation works a couple of years ago. And they chose Tenerife because the infrastructure, so they could fit the vessel here. And it will also play a very important role for the energetic transition with the preparation of the windmills, with all the fabrication of all this stuff which will be being made also in Spain. We are just waiting for some regulation to take place, but there is a space available. There is infrastructure which is readily available. And last but not least, why am you telling you this? Why, Miguel, are you telling us all this? Because basically, Tenerife offers a number of reasons to do business there. Being the first one, for example, the corporate rate for the Canary Islands special zone, which it is just 4%. It's true, however, that operators must apply to be inside this special zone, but under certain requirements, but it's quite an easy task. Also, because we offer a free trade zone in Tenerife, and speaking again, cost efficiency, not only that, but also the discounts we are applying, as I mentioned before, the 50% discount for OPS operations, and also a 40% discount in the vessel tax for transshipment only operations. And also operational excellence. The latest container port performance index from the World Bank said that Tenerife is the third port in Spain and the 71st port in globally, right? Which is quite a number, being a smaller port, which being that it's still efficient as much as possible. And as I would like to finish, as I started, because of our strategic location, there is no doubt we are in the amidst the main major trade lanes, with direct connections to the Americas, to Europe. There is we are connected to a number of nearly 3,000 ports globally, with being, for example, the most important ones, obviously in southern Spain or the Mediterranean area, but also here in Rotterdam or northern Europe. And with all that, I leave you to open the floor to questions, and I thank you for your great attention here. Thank you very much.
Thank you very much, Miguel. I think your presentation raises a few questions, and maybe we'll return to that when we come back at the end from the floor. But if I can return to one of the concepts we were talking about in actually the first session of the day about crisis and opportunity. You know, obviously there's crises around which are having an impact on flows of goods. Are there opportunities in terms of consolidation for ports at the sort of periphery of the EU, or are these ports going to be impacted by the ETS, something we talked about a little bit earlier, as well as one of the threats?
Absolutely, there are opportunities. I mean, sorry, operators of any kind have been using Tenerife since a couple of years, but we have seen a positive trend since at least 2022, 2021. With the Red Sea crisis, these numbers have also increased. We are expecting nearly a 270% increase in the number of TEUs moved through our port in 2025 if we compare with the same period of 2024. Regarding the ETS, It's a very good question because it poses a challenge for outermost regions like the Canary Islands, but also opportunities for to be more sustainable in some way. Because even though the Canary Islands, as an outermost region of the EU, are not they are not obliged to do any investment or to follow the same steps as continental Europe. We still do investments, and we even have engaged with the European Commission to try to present the special situation our region, as for example Madeira, Azores, or any of the French outermost regions in the European Union are facing, and that's one thing we have been doing since the very beginning. Our point of view here is that we need this kind of stuff, like the ETS regulations, to be not an unilateral issue from the EU, but better a matter to be raised by the IMO. Because otherwise we may be at risk, for example, taking the example of Grimaldi doing these operations from Southern America to Europe. What if these Grimaldi ships go straight to an African port without calling in Tenerife or in the Canary Islands, and after that, going to Hamburg, Rotterdam, or any of the Northern European ports, and then with a feeder back to Tenerife? It will pose a challenge for us as an archipelago, because we will lose connectivity. The European Union in its whole will lose competitivity, and by losing that, we will also have an increase in prices for the islanders, because now we have another additional step going forward, rather than being directly connected to the main markets. So this is a challenge, and we are working on it, trying to solve it along with the other outermost regions of the EU, and of course with the European Union.
Okay, thank you very much. Right, I think next up it's Eric Hooper, Senior Associate at Ports and Terminals at Drury, an organisation which I'm sure many of you will already be aware. So over to you, Eric.
Thank you, John. So for those who don't know me, my name's Eric Hooper. I'm Senior Associate with Drury's Ports and Terminals division. We do research and advisory work. We produce regular publications on a monthly, quarterly, and annual basis. I joined the ports industry in the late 90s, and that'll become relevant as we go through my presentation, because I'm taking a slightly broader view on what's happened in the industry. I think Peter did a fantastic job talking about what's happened in the last 90 days and the current uncertainties in the market. So I was trying to look at what are some broader perspectives that could be taken from what's happening in the industry at the moment, and what lessons and what can we learn from that. I started with P&O Ports in Europe, in the London office, in the late 90s, and then spent time in Australia and also in Dubai, and I've spent so over 25 years traveling around the world, dealing with container terminals. So this is a brief snapshot of the majority of the last 20-odd years of the terminal industry. So in the 90s and the 2000s, we saw tremendous growth. It's what first attracted me to the terminal industry. The numbers were all black. There were no red numbers at the bottom of the accounts. Terminal operators made very good money, growing at double digits every single year for 2 decades. The general growth was about 4 to 5 times global GDP. Conditions were ideal for trade. Trade was opening. The accession of China to the WTO in 2001 spurred that even further. And so we see here in the 90s and the early 2000s, we see the rise of global terminal operators. They were able to take advantage of ports, public ports, which adopted the concessionaire model, and were able to grow global portfolios very quickly. Post-global financial crisis, we see a huge slowdown in the growth in the market. Concession opportunities became much more scarce, and the growth in portfolios correspondingly became scarcer. And we see that continuing post-COVID with even slower projected growth rates within the industry. Our current Drury estimates between 2025 and 2030 are for growth between, what have I got there, I haven't got it, it comes later, but about 1.5 to 2.7% for the next 5 years. And each stage in this chart shows slightly different phases in the terminal industry makeup. So the initial growth phase, we see the rise of the GTOs. In the middle phase, we see the introduction of the institutional investors, pension funds and infrastructure funds that were looking to take advantage of the cash flows in the industry. And then finally, we see the rise of the hybrid operators post-pandemic. So this is when many of us up on the stage perhaps joined the industry in the 90s. We see here the middle grey, light grey. Wasn't being very colourful that day. The middle grey bar shows the growth of the terminal operators, the global terminal operators, the private terminal operators. And we can see from the early 90s to 2002 how they dominated the industry. During this period, Hutchison grew at over 20% per year for nearly a decade, and by 2002 was handling over 13% of all global container trade. In the 2010s, there was a dislocation in the mid-2000s and the first round of consolidation in the industry. It was led by DP World when they acquired first CSX World Terminals, followed by the acquisition of P&O Ports, which doubled the size of DP World. PSA, who had been a suitor for P&O, then acquired 20% of Hutchison. These deals in the mid-2000s, we haven't seen the scale of those deals in the 20 years since then until this year. So what happened in the 2010s? We saw post-global financial crisis, we saw infrastructure funds with very strong, very deep balance sheets hunting for strong, stable cash flows. And they came in 8 of the top 10 deals between the global financial crisis and the pandemic were led by institutional investors, by financial players. So we see a change in how the industry was growing. Global terminal operators were happy to monetize some of their assets, to provide funds to enable them to further enhance and expand their portfolio. So we move on to this third stage, post-pandemic. The little chart you can't really see the numbers of in the bottom right. That's the profitability of the shipping lines over that COVID period. And even without seeing the numbers, you can see just quite the extraordinary profits that were made over those couple of years, which have enabled the hybrid operators in particular to come back into the container terminal market with significant weight behind them in terms of potential acquisition opportunities. And that's exactly what we've seen here. Between 2019 and 2033, MSC and CMA have been growing their portfolio at 3 times the industry average. The hybrid operators obviously have been using this as a strategy to support their core liner business. So there are 4 ways which terminal operators can expand their portfolio. And they each come with different risks, both capital risks and commercial risks. The least risky option of all is organic expansion. That is to expand an existing terminal asset that the terminal operator currently owns. You already have a customer base. There's a requirement for or greater demand for it. So therefore, there's the least amount of capital. It's the least costly and the least commercial risk. But of course, to do that, you have to be in the right market in the first place. So if you're not there, what can you do? The next least risky option is to go for a concession. However, since the early 2010s, there are far fewer of those available. There are very few public ports now still looking to offer new concessions. So whilst an attractive proposition, it's unlikely to come around very often. So what else is there? You can go for a greenfield development. That is, you build a new terminal in a new place which doesn't currently offer container port shipping. So that has major risks, especially in a low growth environment, and especially if you can't offer guaranteed container cargo trade. Hence why that is really most attractive in high growth markets, specifically South Asia, Southeast Asia right now, and also to hybrid operators who can guarantee a core cargo base whilst they're building the terminal. So really that only leaves one option for someone who wants to expand into new markets, and that is M&A. And as we will see just now, that has been the preferred strategy for the majority of the hybrid operators. So this is Drew's current market forecast without the latest acquisition that's been mentioned earlier this year. This is the latest capacity forecast for the major global terminal operators for the next 5 years, up to next 3 years, up to 2028. And you can see that the majority of the capacity that's being added to the total market comes from organic expansion, and then we can see. And obviously, the very big expansion at the top, that's PSA's organic expansion in Singapore itself, the Turas megaport development that's going on there. But we can also see that there is still greenfield development going on. And again, this is specifically largely relating to South Asia and Southeast Asian markets, where there is both a much higher growth available, and it's largely led by hybrid operators who are able to provide their own cargo to that new development. So we move on to my main point, which is about the rise of the hybrid operators. We have CMA and Hapag-Lloyd are both worthy of mention in the last few years with major acquisitions. CMA in the Americas largely, and Hapag-Lloyd the same, with its purchase of SAAM. But the big deals, and it has to be mentioned, the 4 big deals by MSC are really quite a game changer. $30 billion of investment over these 4 deals will double the size of MSC's portfolio over the next few years. We start with AGL, previously Bolloré Africa Logistics. That adds 16 terminals, but most importantly, it adds 13 terminals in 12 countries across West Africa. Every country, basically from Senegal in the north to the Republic of Congo in the south and the West African seaboard, and it provides them with not only with those 13 terminals, but with over 250 inland logistics networks, 66 dry ports, a full African logistics network, and it bought it whole. We then have the HHLA, the Hala acquisition, which has been approved, 49.9% of Hala. That gives it significant capacity in one of the most important ports in Northwest Europe, but equally, it gives them access to Hala's inland logistics subsidiary, Metrans, which is heavily concentrated on the Central European economies, which is highly complementary to MSC's existing Medlog train network, which concentrates on Western Europe. So these all can synchronize quite cleverly together to give MSC good access throughout Europe. But the big one is the Hutchison Ports acquisition announced earlier this year. This is a $22.8 billion bid between TIL and BlackRock, for Hutchison Port Holdings, all of their assets outside China and Hong Kong. This covers 43 ports, 199 berths in 23 countries, and instantly propels MSC and its various affiliates from 6th place to the top of the global port rankings by our measures. It's a huge deal that's highly complementary, again, to MSC's existing portfolio. So Hutchison brings with it assets in key markets that MSC did not have a presence, or TAL did not have a presence. That's both coasts of Mexico, both sides of the Panama Canal. In Europe, it's the UK and the Netherlands and Spain. In the Middle East, it's Oman and Egypt. In South Asia, Pakistan. In Southeast Asia, where TIL was actually quite light, Hutchison brings Lam Shabang in Thailand, it brings Port Klang in Malaysia, and it brings 2 terminals in Indonesia as well as a terminal in South Korea and in North Asia. And so this is where we will be if the deal goes ahead as announced. So on the top one is this is all 2023 data. We're currently working on the full year 2024 data. So this is 2023 data. So the top bar chart is pre-acquisition, and the bottom bar chart shows what it would be if the full acquisition goes ahead as planned, leaving the MSC group, including TIL, AGL, HHLA, Wilson Sons, and Hutchison Ports, as the clear leader in the global container terminal operator market. And so I'm leaving you with a little bit of a cliffhanger or question, which is, for the first time ever now, 3 hybrid operators will be amongst the top 5 global container terminal operators. Those 3 hybrid operators are also in the top 4 global liner shipping operators. So what does this mean for the future and the competitiveness of independent container terminal operators in the market? Does this still leave a space for them to compete and challenge with the new cashed-up hybrid operators? Quick plug. All of the data in the presentation is part of the Drury publications. Our Ports and Terminals Insight is produced monthly with lots of data, and there's more analysis that comes out on our Ports and Terminals Insight quarterly. And then, of course, our annual review of global container terminal operators, which in my former life within DP World, I was an avid consumer of, and formed the basis of many of my presentations to my senior executives in those days. Thank you.
Thank you very much, Eric. I can see lots of people taking pictures of some of your slides. So I think there's going to be plenty of questions at the end. But maybe if I just crack on to the next speaker, Nigel Pusey of the Container Trade Statistics Organization, who's going to share with us some of his data. And then we'll got one more presentation, and then we'll open it to the floor. Thank you, Nigel.
Yes, good afternoon. My name is Nigel Pusey. I'm CEO of Container Trade Statistics. Oh, sorry, I'm not far enough. Sorry, apologies. We basically are a company that takes the manifests of the larger global shipping companies, and we are going to do a little bit of a presentation on. Peter referred to the fact that the tariffs are coming, but my thesis of my speech today is that there are people who've been planning around the tariffs, in my view, for a lot longer than just the last few months. Because we're starting to see shifts in global shipping, container shipping patterns that have been going on for 6 to 9 months, which are merely being accelerated through what's happening. So, First of all, I'll give you a bit of a global overview, and then I'm going to take you through a few of the trade lanes where changes and patterns of shipping are starting to happen that are interesting and important to notice, as whatever happens with the China-US situation, I think are here to stay. And then I'll just do a few concluding remarks. So, as Peter mentioned earlier, and thank him for using our statistics there, 5% growth in the first 4 months of this year is off the back of over 6% last year. So we're seeing something like 13.5% growth in 2 years. That's the sort of growth we haven't seen in container shipping for many a year, and takes us well back to the days when we were doubling GDP growth. But as Peter said, you know, some of that, is that being dragged forward? Is it being people sort of front-loading, etc.? Some of it is, but I think what I shall show you through this presentation is that things are changing. There are things happening out there which are actually stimulants for further growth. We've seen in March this year the largest ever lift, 16.3 million TEUs in 1 month, which is the largest lift. And even in April, which had 15.7 million, if you take that on a day basis, that's only 250,000 shy, and most of that was due to the fact that of the American-China situation. So we have a very buoyant global container market, as being said earlier. So what's actually happening as we go down? Well, let's have a look at China versus the US. And in reality, the first 4 months of this year, the first 3 months of that, nothing changed. You know, we were talking about a 10% increase on goods coming into the US from China, but suddenly in April, that collapsed. And we were down around 250,000, and effectively that entire year-to-date percentage was wiped out in 1 month alone. So that you can see that the impact in April was significant. This will probably bounce back in May, but it does show that there was an immediate impact on exports out of China into the US, and that's quite a significant movement. So basically, so what's happening with that cargo? Now, one of the things that I'm suggesting here is that China started to realize about all of this a year ago when they saw Trump coming into power. And I think there was a conscious effort to start thinking about where cargo should start to move. And I'm going to go through a few countries here where you can see that that movement has already started to take place. I mean, just to give an overall view, and I'm going to go down into a couple of particular trade lanes, compared with this time last year, exports out of the Far East and China into Indian subcontinent, Central and Southern America, and Sub-Saharan Africa, around 15 to 17% up on a year-to-date basis. In April alone, they're 25%, between 23 and 29% up in 1 month alone. And so we're seeing an attempt to shift cargoes. Whilst those numbers will not make up for China, given the sheer size of the markets, what we are seeing is a shift that has started to take place. And if you look at these graphs, you can actually see that shift has been going on pretty much since the middle of last year. So if we look at East Coast South America, the April year to date is around 13%. In East Coast, it's around 21% when we look at West Coast. And we are seeing significant movements into Brazil, into Peru, Chile, of cargo coming out of China. And I think that shows that the expansion into these trades is a strategy. It's not just something that's just, you know, you're not just moving boxes from one place to another. So I think, you know, in essence, we have to see what is happening in these other markets as we see what's going on in China. And it's very much a reflection of how markets in this day and age can move quickly and not just sort of continue down the paths that they have done historically. Into India, subcontinent and Middle East, very similar. You know, year-to-date increase 15%. You know, we're looking at something like 1 million TEUs more compared from the first 4 months of this year with the first 4 months of 23. So again, this pattern of continuing forecast movement of cargo out of China into other areas, and as other markets start to grow, the capacities of the shipping lines are moving to these areas. The ability I think Peter mentioned it earlier, for the lines to shift their networks into different areas has started to take a pace. And I think what we are seeing now is opportunities in the global market to see these make efforts of value out of these changes. So, conversely, what's happening into the US? Well, interestingly, the US is starting also to look for other places. You know, India into the US has started to become an interesting market. A fraction of the size, obviously, out of China, but we are starting to see some movements there, 10% up on the first 4 months of this year. But interestingly, I think just because of the uncertainty in the last couple of months, even that's starting to suffer just because of the uncertainty of importing into China. Into the US, my apologies. So, Peter was talking about Far East Europe earlier, and it is the slightly strange trade in a way, because remarkably we're seeing some massive volume increases. Far East Europe for the first 4 months of this year is 9% up. And given that that is off the base of an equivalent increase in 2024 over 23, we're now starting to see 17% increase in volumes over a 2-year period, in which the average transit time between Far East Europe has virtually doubled by 60-70%. So it's fascinating that the supply chain has adjusted. We were talking about the capacity issue, or Peter was mentioning about capacity changes earlier. Those capacity changes have been absorbed and being filled. And suddenly, you know, I was at conferences 2 years ago where we were looking at 30% overcapacity, etc. All of those, let's say, worries for the shipping lines, concerns for the shippers, have changed. And effectively, that is being used to a degree that nobody would have predicted. Interestingly, the price index, and we monitor a price index as well as the volumes, and we are seeing, you know, whilst Peter was talking about the spot rate and the long rate, in fact, in terms of where we are compared with this time last year, the average rate across all those industries and all those contracts has changed little. So we are experiencing a very unusual market, but we're seeing changes in Far East Europe, which is continuing. Now, is that due to concerns of things? I doubt it. 17% over a 2-year period is very unlikely to be, people dragging through an additional amount of cargo for warehousing, because 17% over 2 years is massive, which is slightly surprising when you look at the European economies. Those changes haven't taken place. So what's been driving that? Well, there's a number of things, I think. The major lines have obviously been seeing significant cargo increases. But what's fascinating, particularly in the Far East Europe market, and this is not always significant for volumes, but we're seeing an awful lot of new entrants into the Far East Europe trade, particularly in the West Mediterranean. There are lines out there that can, you know, Peter was showing his the graph or the map of the boxes moving through Suez. We've been tracking various lines that have started to move, that can, how shall we say, let's say, move through Suez. And we're seeing a pickup in significant amounts of cargo coming out of India, out of the Far East, into the West Med, as a result of the, let's say, geopolitics position we're seeing at the moment. So the Far East Europe trade is very high, but it's not seeing the sort of price rises that we saw during the COVID times. So what other things are affecting this market? Well, people have said to me, well, you know, is the China coming through, is the China cargo for the US coming through Canada? Well, clearly not. It doesn't seem to be moving that way. So there's clearly some, you know, movements of how do people adjust to the US market. That hasn't been happening. But we are, you know, starting to see people thinking about how they're going to move cargo into America. And I think that uncertainty will continue for the rest of this year. So, what does that really leave us? Well, we have global volumes at numbers I don't think we ever expected to see. As I said, 5% this year, 13% over a 2-year period. We're seeing China pushing for volumes and thinking of new markets and not just relying on pumping the cargo into America. As I say, these increases into these areas, they're not substantial enough yet to make up for what they would lose by going to America, but they are making some significant inroads. And I think it's going to be fascinating to watch how that continued growth underpins global growth for the rest of this year. Asia-Europe, still, as I said, 9% growth, and despite all the operational challenges and the way that the industry has adapted that supply chain, is still seeing significant volumes move in this period. One of the things that we picked up, and I didn't mention this in the earlier one, but interestingly, the US exports out to China, whilst a very fraction of number in global terms, was something like 60% down. So whilst imports into America, as I was saying earlier, were down by 23%, actually the exports out of America were hit much more hard in terms of container volumes than the imports themselves. So we're watching a fascinating time. We're not just looking at a US-China trade war. It's how does the global market react to this disruption? It has become much better at recognizing that the global market, that there are markets out there that can absorb additional demand, and the operators are flexing their networks to make that change happen. And I'm pretty confident that we're going to see that pretty much for the rest of this year. Thanks very much for listening.
Thank you very much, Nigel. Very illuminating presentation, and I think we'll return to some of those themes in a minute. But let's move on to our last presentation now by Theo Notteboom, who is Professor and expert in port economics, port and maritime economics at the University of Antwerp and Ghent University. So Theo, thank you very much.
Thank you. Thank you for the introduction. So I'm Theo Notteboom, linked to various universities according to my name tag. But I also have a history, for example, in China. I worked many years at leading maritime universities in Dalian and Shanghai. The previous speakers already eloquently provided their insights on what the container market is doing, where we're heading, and what are the current challenges. I would like to add a few additional perspectives on this issue by using the output of a recently published report by International Association of Ports and Harbors, IAPH. And this report bears the title World Ports Tracker 2025 Sustainability and Market Trends. This report was released very recently, only 1.5 months ago. And it was an interesting journey in the sense that we tried to bring together data on sustainability, but also on market trends in one comprehensive study, combining both data sources with also inputs from a survey that was conducted among the many IPH members. Today I will particularly focus on the market-related part of this report. And the first thing, and as we are talking about uncertainty in the market and geopolitical disruption and so on, it's always interesting to see what kind of risk factors are high on the agenda of port authorities. Now, according to the survey we conducted, the number one concern, the number one risk factor by far is cybersecurity. Not far behind, we have natural disasters and climate change impacts. So these are also still very high on the agenda of port authorities, and they should be. Where does geopolitical situations come in? Well, they are somewhere in the middle in terms of all the risk factors. And you might wonder why they're not higher. Well, there might be several impacts. Some of the developments that are taking place, particularly at the level of Trump administration, are of very recent date. But also, and that was already highlighted also in previous presentations, geopolitical disruptions can also lead to opportunities for ports. And we already saw that some port regions in the world are benefiting from the situation that we have right now, and particularly then the tensions, the trade tensions between China and the US. Now, if we think about geopolitics and the impact of geopolitics on shipping and ports, we often focus on trade-related impacts. We talk about things like friendshoring, trading with friends, buzzwords that you see more and more in publications. We talk about strategic autonomy, countries that, or regions that want to have their own independence when it comes to critical sectors and industries. And we also talk about trade decoupling and realignments. And some of the figures that have been presented previously already pointed in that direction. However, there are also other aspects that are extremely important when it comes to geopolitics and ports and the shipping market. One of them that should not be neglected is the whole issue of investment and control of assets in ports and in shipping. We had already the big discussions in the US on how, for example, the Trump administration wants to bring shipbuilding back to the US, how they want to develop their own national fleet, and also try to impose impact or sanctions, some sort of sanctions on, for example, Chinese-built container ships. A third element that's extremely important, in my view, will become more important in the future, is the fight for the strategic choice points in the network. Corridors and networks are going to be essential in the geopolitical fight, and we might even see a kind of disconnection between world powers in terms of which networks and choke points they are going to focus on in terms of securing their access to their part of the global market. And the last one, and this is to me a very worrying one, is the fact that we see that ships and ports have become targets in geopolitical fights. Ships are being used, ships are being used, for example, in sabotage cases. We have seen that in the Baltic and the North Sea recently, but also ships themselves become targets. Think of the Red Sea crisis. So it's a very complex picture when we talk about geopolitics, shipping and ports. Now, how do port authorities deal with that? Well, port authorities are very eager to take initiatives in the field of health, safety and security. You see here percentages of ports that are active in taking initiatives in this field. And for example, you can see that 81% of the ports are very active in developing, for example, business continuity plans, or in bringing stakeholders together in order to address priority risk factors affecting the ports. So port authorities are on top of things and are trying to mitigate and adapt as much as possible to these new threats and risks. What's happening when it comes to strategic decisions in ports? This is one of the questions we had also included in the survey. And this gives you an idea of what kind of terminal capacity expansions or major upgrades will become operational this year, so still in 2025. And it's very interesting to see that container terminals are the top scorer. So no less than 1/3 of all the surveyed ports indicated that they will bring new capacity on stream this year. And that might also reflect a bit the focus on containers and the fact that there's still growth in that market, at least in the short term. You see also other markets, but overall container terminals are the main focus in this story. And the same applies to the land dedicated to specific activities in ports. Obviously, ports are investing a lot in things like the energy transition, are also making land available for these kind of new functions that ports are adopting. But the main focus in terms of land management is still logistics, distribution, and container terminals. On this figure, you can see that about 33, so 1/3 of all the ports are dedicating more and more land to logistics and distribution. And you also see that about 1/4 of the ports are dedicating more land to container terminals. So these functions are still extremely important when you look at the overall land management in the world ports. What about their expectations for the next 12 months? And this seems to be a little bit counterintuitive, but it's clearly demonstrated, particularly if you look at containers, that ports generally expect to either have a rather stable development of the container business in their port or growth. There are no ports indicating that the volumes will decline. So again, underlining some of the statements that were made before, that while the container market is not in a weak kind of position right now, at least in volume terms. There is still a lot to do. There are also some other data points that we have included in the study. And here is an interesting kind of comparison of the container ports around the world, in different regions around the world. And what you see is that between late 2019, so pre-COVID times, and late 2024, overall the number of vessel calls in most ports around the world went down in most regions. Only Africa is the big exception. But on the contrary, we saw the call sizes, so the amount of cargo loaded and discharged per call, going up significantly in most parts of the world. So less vessels, more bigger call sizes. And if you look at port moves per hour, so part of the productivity, you see quite a mixed picture, particularly in Northeast Asia, Southeast Asia, and then to a lesser extent also Africa, are seeing higher productivity figures when it comes to the average port moves per hour, while the rest of the world is witnessing somewhat lower figures. Now, these are, of course, based on late 2024 figures, so it'd be very interesting to see when we get the updates what the most recent situation is like. And then the last set of statistics that we used relates to the liner shipping connectivity index that some of you might know. It's published by UNCTAD. So we also worked a bit with that and tried to understand what's going on in the five the best connected regions or countries within or locations within a region. And quite strikingly, in North Europe, all of the best connected countries are seeing lower liner shipping connectivity, while in a lot of other parts of the world, the liner shipping connectivity has gone up. In Northeast Asia, we see a mix. China and South Korea are moving in the positive direction, while other parts, like if you look at Hong Kong or Chinese Taipei and also Japan, you see that the liner shipping connectivity has gone down over the last 5 years or so. A few short concluding remarks. I think, and that was also, again, already indicated by some of the figures that we have seen previously. Obviously, what's happening right now has a short-term impact. We see trade volumes shift lanes, and that goes very quickly. And so companies, shipping lines, terminal operators have to move very fast in terms of accommodating these new realities. Does that mean also in the long term we will see impacts? Of course. We will see to some extent the rewriting of the map of maritime commerce, but this will not take place in a big bang fashion. It will take time. It will take many, many years in order to lay out, let's say, a new reality in terms of global trade. Personally, I don't believe this will negatively affect global trade. I don't believe that we are going to see the famous deglobalization on a massive scale that would in the end also negatively affect the container business. I do see still growth opportunities for container market. However, there is one big concern that I have, and it's also an open question or an open-ended question, that is, what's going to determine the flows that we will be handling at ports? Is it purely related to the market strength of the countries and the ports involved, or is it going to be affected more and more by geopolitical and political interference? And what is happening right now in the US is, to me, is very worrying, because they are clearly moving to the second option. They are trying to influence what's happening in the US ports and in US shipping using, let's say, non-market related or market-based measures. Thank you so much, and I'm looking forward to answer any questions you might have.
Very much indeed. Fantastic. Right, well, we have 9 minutes left, so let's open this up to the floor. If there aren't any questions on the floor, I've got lots. So here we go. Right to the end, there's a gentleman on the side, just over there.
Hi, thanks. Gavin Van Maal from the Lodestar. I just wondered if I could get from each of the panel, a forecast for what the global container trade growth is going to be this year? Because I'm hearing a lot of different prognoses.
Yeah.
as it were.
Okay. Well, let's. well, I mean, that is the question, isn't it? And we have seen, I don't know, 17% talked about in terms of volumes and so on. But let's come to you firstly, Nigel. And
I'm not allowed to. I'm not allowed to say a number. But well, of course, and I think 5% is probably, we've seen that, as I said, year to date. I suspect it's going to be a number in the three, around the three. I would think. I think we are going to see this growth that I was talking about in other areas, but it isn't going to compensate sufficiently. And if we do see I'm sure we're going to see a slowing down in Far East Europe as well. So, I think we're probably around half of what we've got at the moment, I suspect.
Okay, Peter, just a number,
No more than 2%.
Well, fantastic.
So Drury released a forecast earlier in the year, just after Liberation Day, of -1%. Then with the pause in China tariffs, we amended that to 1.9%. Now with the latest US-China deal, I don't know. We don't have a number yet. We will come to it shortly. I suspect around 2% is probably where it'll end up.
This one is a very difficult question. And from my point of view, this gentleman here has more wide knowledge of the market globally. The numbers you saw on the screen, I was speaking about a 12% increase from 2024 to 2025 in TEUs moved in my port. And that was last week, before Friday, before all these new events in the Middle East. So I think that's going to change, and that's going to make things change a lot.
Yeah, wow, that's a high volume. Based on the IPH results, we actually looked at the forecasts presented by the different port authorities in terms of different classes. And if you take a weighted average, you end up with about 3.5% to 4% growth. But of course, that was a snapshot taken at the moment when the survey was filled out by the port authorities. So, as you said, it can change overnight. But that's a little bit the range.
There you go, Gavin. That's a range of numbers for you. Happy with those? Any more questions from the floor? We have one at the front over there, and then a second gentleman over there. I think that will probably be sufficient to take us up to lunch.
Hi, I'm Rohan from Sri Lanka. Just to know about the transshipment incidents, are you seeing increase in transshipment, or are you seeing increase in direct port calls?
Okay, who would like that? Theo, probably. Is that something that you can talk about in terms of patterns of trade?
I've not looked into the recent figures on this, but what I see is there is some kind of differentiation taking place at the level of the shipping lines. And of course, we have like the Geminis, clearly hub-based, lots of feedering and what have you, and then MSCs. Particularly if you look at some of the more recent changes in their liner schedules, they actually include a lot of ports of calls. Combining it also with of course, the different hubs they have developed alongside each coastline. So it's a very mixed picture. So each company goes develops the network in their own way, and they don't go in the same direction. Overall, what I know from the past is, for example, the average number of ports of call per round trip on quite a number of trade routes has gone up instead of going down over the last 10, 15 years. There was a time when it always went down, but it seems that due to market pressures and so on, there is a little bit more room for more direct calls instead of only focusing on the big transshipment hubs.
Yeah, that's a good thing in terms of, I suppose, integrating many companies into the global trading system. Eric, have you got anything to add to that?
I'd largely agree with everything Theo just said. The one thing I would add is that over the last 18 months or so, we've seen a steady decrease, and this is again something that Theo mentioned in his presentation. We've seen a steady decrease in the number of port calls overall and a steady rise in total throughput, which means there are much higher exchanges going on for each port call. That implies there's a certain amount of transshipment and feedering going on, but I think the overall proportion globally isn't varying enormously from what's been historic.
Thank you. Peter, just quickly, and then we'll move on to our last question.
The one thing that worries shippers is that cargoes are not meeting the estimated time of arrival. So, I mean, Eric, you point to the fact that will the hybrid version of terminal operators, those that are run and owned by the carriers, make a huge difference? I expect it will be so, because otherwise those money would be not well spent. So keep your eyes out on whether or not the hub and spoke by Gemini will actually deliver in the end. And then you can do, while doing that, you can ponder the investment made by MSC into the Hutchinson ports, because that was definitely a catch-up in a short while. Maybe not for the same network strategy, but in the end, they all do extensive transshipments, regardless of the marketing name of it. So, but I would expect more reliability coming about due to the hybrid operators or those terminals and carriers running their own show. So, but it's always in the proofing of the data in the end. So hopefully they will do.
Thank you, Peter. Time for one very quick question at the front. Where's the...
This is for you, mate.
He's not going to talk.
Thanks again, right? I think this is the first time I see all the illustrious industry experts in the panel. Thank you very much for your insight. My question is more to do with Asia to US. Many of us are impacted by the tariff. We see a tremendous increase in volume, that's for sure. But my question to the panelists is that, is this increase in volume due to front loading, or are we going to see substantial increase in volume the second half of the year?
Okay. Peter, last word for you.
I expect that we are in the middle of an early peak season. We are seeing shippers not risking anything on wishful thinking, regardless of the, say, positive vibes between US and China these days. 55% of tariff is still massively high. So what we anticipate is for the short-term market rates are literally peaking right now, as carriers are preparing also for that early peak season around. And it's not something particularly new. I mean, it's almost a bromance up here, but looking into to some of Nigel's stats, you can also see that the so-called, well, the traditional peak season has come earlier and earlier on the Transpac in particular. So this time around, we anticipate something of the same, but it's very much a stop and go. So all the volumes being moved ahead of the mid or early July and mid August deadlines will definitely ease the demand growth for the second half of the year. So that's how we see 2025 on the Transpac moving out, Peter. Stop and go, and peaking now on the short market.
I see everyone nodding their head on that. Is everyone happy with that, or does anyone want to come in? No? Fantastic. Well, I'd just like everyone to show their appreciation for this great panel and expertise. Thank you very much indeed. So that's it for the morning. Just an additional word from me. Right at the beginning of the morning, you will have heard Paul say that my book, The Death of Globalization, was available to buy. That wasn't quite right, but my another book, called The Good Supply Chain, is being provided by our generous host free of charge as part of your delegate package. So I will be signing some of these books during the lunch period. So if you'd like to have a free book from me, then please see me afterwards. But thank you very much, and we'll see you after lunch.